So Dionni, thanks for meeting with us.
Oh, you're welcome. Thanks for having me.
Yeah. So we're here at Keller Williams City View. What can you tell us about lending and interest rates? It's been a big talk recently.
Yes, it sure has. There's been a lot going on in lending and with interest rates. A lot of people are interested in what's going on and what's going to happen this year, and everybody's holding their breath to see and waiting to make a move so that they are getting the best deal. But what I can tell you is it seems that at the end of the year last year, everybody was sure that rates were going to get cut by next month or by today, starting today. This month was going to be the beginning of this year being, the year for change, and we're going to start seeing some more affordability. And what I was thinking about that time last year, when everybody's kind of like applications kind of like stopped in December and everything kind of like fell off. Well, I thought that everybody was like holding out for March because everybody was sure rates were going to get cut in March, and that's when rates were going to come down. Well, that's not happening, and my gut was telling me end of summer, and my gut is telling me now that it's going to be closer to the election, so it's going to be after July. I think it's going to be more like towards the fall, and I have my political reasons for thinking that, but I think it's more of an election kind of thing than anything, but I think that where we're headed is in the right direction. It's just going to take a little longer.
Gotcha. I mean, no one has a crystal ball, but what do you think by like the end of this year? What do you think rates will look like?
I think based on the research that I've done and based on what I've seen in the last couple of years and how slow things have moved, I think we're going to be somewhere right above 6% at the end of the year.
Gotcha. And is that better if someone has like really good credit and a big down payment?
Yes, obviously the higher the scores are, the better your interest rate's going to be. Now, the down payment isn't always the key on a conventional, because the investors have a tendency to give you a better interest rate slightly, eighth of a point, quarter of a point better. When you have a higher loan, when it's a lower loan to value, put less money down because you have mortgage insurance. They even it out a little bit, so they give you a lower rate because you have mortgage insurance, because the payment's going to be evened out a little bit. Mm-hmm. So a lot of times you'll see a 20% down payment, or I'll see, because I'm watching the rates, I'll see a 20% down payment be a slightly higher interest rate than a 5% down payment. So even if with a good credit score, and that's just the nature of how the rates work and how pricing works. So 20% down isn't always the magic number, but it does get rid of mortgage insurance. So when it comes to wanting to get rid of that, maybe you're in the 700s or the low 700s, and your mortgage insurance would be a little bit higher, but you still qualify with conventional with that 700 or 720, 740 score. Maybe your mortgage insurance would be higher, but you have 20% down. It's probably a good idea to go ahead and put that 20% down, because the mortgage insurance would be expensive on that. So different factors, and that's where your mortgage broker is going to tell you, hey, this client would probably benefit for using that 20% for this. It's just a financial conversation to talk through.
Okay, then what about do you think we'll ever see rates come back to the fours, or even do you think we'll see 3s and 2s ever again?
No, I don't. I have chart. I'm a total numbers dork, so I will chart all day long, and I'll look at the historical figures and see where interest rates have been, and they've never been down there. That is literally a crisis interest rate. Now, you have to think back at what our country is built on. We are a capitalistic society. We are built on debt. That is what our country was made on, built from. And you can't build a country on debt and run on debt with 1% and 2% interest rates. We are not going to survive. Lenders don't make money on 1% and 2%, and that's what makes the money, pays the payroll. That's what keeps this cycle going. So unfortunately, that's not a realistic number to see in our American society. So 2s and 3s, no. 4s, maybe, because we were in the 4s in 19. So we do forget a little bit about what happened before COVID. Everybody is so, COVID centric that we forget life before COVID. And it was in the 4s before COVID hit.